What's up, millennials? In this video, you're going to be listening to an interview that I did with Mark Hake. Now, you might actually know this guy, especially if you've read a lot of articles on Investor Place about SPACs, because Mark writes a lot of articles. I think he even writes like 15 articles per week, and many of these articles are about SPACs. Also keep in mind that Mark is actually the one who I learned my SPAC valuation methods from. But before I start the interview, if you know a lot about a certain company or a certain stock or a certain cryptocurrency, and you also want to have a chat with me, then actually send me an email at support@nesami.com and we can see if we can have a chat. All right, let's start the interview. Enjoy! All right, everyone, today we're going to have an interview with Mark Hake, and he's like the king of SPAC valuations, I would say. Mark, why don't you introduce yourself for a second?
I'm a analyst. I'm a chartered financial analyst. I live here in Scottsdale, Arizona, and I sort of have retired from the investment management industry and investment research. I'm just sort of managing my own money, and I do write articles online. I work for investorplace.com, where you can see a lot of my articles. Plus, you can see some articles in medium.com. My site there is mrmedium.com. So I focus on stocks and SPACs and alt currencies, that kind of a thing. Typically, what I like to do is just see what a stock is worth versus its price right now. And
Okay. And you
there's a
mentioned
lot of
that
opportunities in the SPAC industry right now.
Yeah.
Although I do think it is getting a little heated.
So you mentioned you were a chartered financial analyst, is that correct?
Yeah, a CFA.
Could you explain to, especially I suppose, the European audience what that is exactly?
Well, it's a designation you get after taking 3 tests. You can only take 1 test a year,
Okay.
and you have to have three years of experience in the securities industry. So the first test is very, very hard. Only 50% of the people pass it.
Oh, wow.
Essentially, you have to study for a year.
So that's what
But
you needed as well for the SPAC valuations, or did you come up with your own method
that's
there?
what you need to get a job on Wall Street, more or
Ah,
less.
okay. Right.
You don't necessarily need it, but you're not going to advance without it. Let's put it that way.
Right.
But anyway,
Yeah, so let's talk a little bit about SPAC valuations, because I've been doing a lot of SPAC valuation videos myself on different kinds of SPACs. And some people actually wonder if these SPAC valuations are actually useful, because I think a lot of people say that valuations don't matter anymore, and people are just looking at stocks that are very hyped up. So, and I think many SPACs and also many stocks just seem very overvalued. So yeah, do these valuations even matter anymore?
yeah, a valuation always matters, because if a stock moves too high a stock is always tethered to its underlying value, whether or not the market realizes that or not. It still is tethered to that underlying value, and it may expand or get overvalued at some point. But at that point, the market tends to push it back to its underlying value. So you do have to have a sense of what the underlying private company's value is in the SPAC merger deal prior to it going public, or in essence, the reverse merger closing.
Okay.
What I find very useful, and I've pointed this out in many of my articles, is that the SPAC deals that have been going on for the past 2 years basically provide enough information, way more information than you normally get in an IPO transaction. And I'm pretty pleased about that. Now, there are some drawbacks, but that is the single most important thing. You get way more information from the private company that is not yet public. So there's no other way to get this information. And I've been a CFO of several private companies, so I know how this works.
So you mentioned that we do get a lot of information, but sometimes I actually wonder if the companies, if the SPACs are actually trying to oversell themselves,
Well, that's true. There's always that risk. The problem is, what are you going to do when your earnings come out, especially your first quarterly earnings, and you're nowhere near the mark or even on the run rate mark of where you're supposed to be. The CFOs and the CEOs know that the market will be sorely disappointed, and in a sort of slow motion way, that's essentially what happened to NIKOLA. All of the sort of promises and statements that the guy made, Trevor Milton, by the way, that's in the same town I'm in here, Phoenix. He basically went too far and he got hounded out. So if you will, the companies have to stay within a reasonable range of where they expect their earnings are going to be. Now, they don't sign any kind of statement saying, I certify that this is what is true and accurate. They don't sign that in their forecasts, right? Once they do become public, then they do have to sign an attestation that, so when they're going to bound to be way more conservative once they give their outlook as a public company.
Dang, that's actually interesting to know. I didn't know that. That's good to know. That's how can
you
people
look at the end of every 10Q, they have to always sign a document saying we attest. By the way, this only happened about 3 or 4 years ago where they had to start doing that.
So, because there are quite a lot of space SPACs, if you will, some like rocket launch companies that don't have any revenue for like the next coming 2 years. And then after 2 years, they actually expect to have some kind of revenue. And then after 5 years, all of a sudden, they have billions of dollars in revenue, according to their own investor presentation. What do you think about those kind of
pre-revenue companies? It's a very risky thing, I think, to invest in those kind of companies. You're essentially getting into the business of private equity and maybe even venture capital as a public company. Now, there are a lot of very successful companies like this, especially in the biotech arena.
Okay.
So it's possible that that's the case, but at that point, you have to assess the technology and what the value is of the technology.
Right.
If it's a software company and they're claiming they're going to have revenue at some point, something's not adding up there.
So you think these space companies could actually be true?
Well, what kind of, you mean rocket space?
Yeah, I think there are certain SPACs, I'm not sure if you looked into them. NPA, for example, which I believe is going to merge with AST Space Mobile.
Okay.
HOL is going to merge with Astra, I think. And SRAC with Momentous. So these are all space companies that are...
What I would do then is I would analyze, do they have a rocket actually ready to go, or are they still trying to build the rocket technology?
Yeah.
If they've got a rocket ready to go and they've had successful launches, they should have been able to sign up some clients. So at that point, look whether or not they've signed up some clients, whether they actually have contracts.
Yeah, that's a good
one. If they have no contracts and they don't even have a rocket technology, well then it's just abject speculation, and you're just really in the venture capital business in that kind of SPAC. They're not going to raise a lot of money, I wouldn't think, and I don't think that companies without pre-revenue, without a significant spike in revenue upcoming that people can sort of lash their hands on, they won't be able to raise that much money without that.
Makes sense.
The main problem I see with SPACs, let me just go, before I said that there's some issues. The main problem I see with SPACs are that the sponsors of these deals are normally getting a higher percentage than they would normally get than, let's say, if it was an IPO deal. And the PIPEs, the private investment in public equities that are making investments in these SPACs, are getting sweetheart deals right in front of everybody that I don't think can last. The sweetheart deal is they get to invest in almost every one of these deals at $10 per share, even when the SPAC is trading at the announcement time at $15 or even $20 per share. So at some point, there's going to be a situation where the SPAC investors will simply turn down the deal because the PIPE investors are getting too much of a cut, if you will, out of the deal. That may happen, or if somebody's really smart, they'll put together a fund where you can invest simply in the SPACs, I'm sorry, in the pipes that are doing these SPACs. In fact, I'm looking for one right now. So these SPACs basically are putting up capital, and they have the same deal as everybody else, except they're getting guaranteed that they get to buy in at $10 even when the merger closes. And by the time the merger closes, if it's anywhere near a successful deal, it's going to be way above $10.
Right.
So they have almost no downside risk from my standpoint.
Yeah.
They can literally just borrow the money, and they probably almost all of them are just going out and getting a line of credit just to do every particular SPAC deal without even having to actually have the cash in their bank.
Do you think these like sweetheart deals, as you call them, could be actually an issue for the retail investors, people like me and the people that watch my videos?
In what sense? Well, you know, the SPAC investor normally, as a group, aren't normally as a total post merger ownership stake, normally not more than 20 to 25% of the total deal. Right. For example, the private company usually gets anywhere from 50 to 80% of the deal. The sponsor gets maybe 5%. And the SPAC might get 10 to 20 to 30% of the deal.
Yeah. Right. Makes sense.
Now, what I like are SPACs where there is no pipe. There was one real famously, and I mentioned this to you the other day, Lancandia, which did the Golden Nugget gaming, online gaming. They avoided that because the sponsor was a very astute gentleman, Tillman Fertitta, who recognized this. It took a while for the SPAC to actually pass the merger because the pipe wasn't there to actually, you know, sign up for the deal and give enough votes to get the deal across the line. However, now the SPAC investors own a much larger percentage of the company, so they'll get a larger percent of the total earnings. And if the company decides to raise any more capital, it'll be at a market price.
Right. Okay. Do you think we should get rid of these pipe investments altogether, or just change the rules maybe? Or
well, again, there's a trade-off because the private company is only willing to do this. Typically, the pipe will add in anywhere from 50 to 100% of the amount of money that the SPAC itself is providing.
Right.
So it's essentially a guaranteed deal for the private company to know that the SPAC money is there for them and the pipe money is there for them. They can maybe even go out and get a bridge loan immediately once they sign the deal. All right. And they can get access to that capital immediately. It takes 3 to 6 months for some of these to close. They can get that money, especially if they're growing really quickly. They know exactly how much they're going to get. They know what their ownership stake is going to be. And in fact, in some cases, they will be cashing out. Some of these SPACs, and I always ask people to pay particular attention to the SPAC deals where the owners of the company are actually cashing out some of their ownership. Just like in a regular IPO, you typically don't want to invest in those kind of companies because why are they selling their stock? They're supposed to be in this for the long term. I know that people need liquidity, but I don't see any reason why they can't wait another 6 months like everybody else.
Right. Do you think this could be an indication of a possible SPAC bubble, or does this has nothing to do with this?
No. For example, sometimes with software companies, they are already pre-owned by a private equity fund. Okay, and management itself only owns a small portion of it. So the private equity fund typically wants to get its money back within 5 to 7 years, and they've been hanging around for 5 or 7 years with the software company. So in the SPAC reverse merger, which they consider a exit transaction, they typically like to take 50% to maybe even as much as 80% of their investment out of the way. Right. Now, if it's a number of private individuals that own the company and they're trying to get money paid out to them at the SPAC merger closing, then I'd be a little bit more concerned.
Right. Do you think, because I do think you said at some point that SPACs seem to be more and more speculative right now. Is that correct or not?
The valuations have moved way up. By the time the closings have happened, especially with electric vehicle stocks, you're typically looking at 10 to 15 times revenue by the time of the merger itself. So I'm finding that the valuations have moved way up. I just wrote an article recently on a EV merger ACTC with Proterra.
Right.
The valuations are already pretty full, but I mean, there is still some room for the stock to move up. So typically the play then in this case is I only buy SPACs once there's an announced merger, but once the announced merger happens, I like to look at them very carefully, very quickly.
So what's your strategy exactly then? So you buy them if you actually like them. Do you sell before the merger? Do you keep holding your shares until the merger?
Before the merger, yeah, because by the time the merger closes, it's pretty much valued. The merger closing is irrelevant from my standpoint.
Okay.
In fact, if anything, it's a buy on the rumor, sell on the news type thing.
Yeah, exactly. Yeah, that's what I've seen as well, because I've done one video about like 5 different SPACs that already had their merger completed like 1 or 2 months ago. And you saw with all the 5 SPACs that right after the merger happened, it either went down immediately or it went up for like 2 days and then came down quite a bit, like 20, 30% or something like that.
If smart, they would already pre-announce, or they would announce within several days after the merger what they're going to do with the money. Okay. Those are the kind of SPACs I like. If they've got something lined up that they're going to do with the money, hey, they need to buy a whole bunch of new inventory because they just signed a massive new contract, and they come out to press release on that, or they just found a company to buy, right? In one case they started buying the Bitcoin with this wasn't a SPAC actually. I wrote about this stock, Mara, M-A-R-A.
Right.
But in other words, if the management is enlightened, they will realize that the merger itself is nothing that anybody cares about from the standpoint of the SPAC shareholders. A lot of other people in the deal care about it. And they might want to, make some announcements to say, okay, now we got the money in the bank. Here's what we're going to do. Here's how our first steps are happening, blah, blah, blah.
To be completely transparent with the investors.
Yeah. And that, they got so much on their plate, but that's the kind of thing they need to do. If they don't realize that, then why should I stick around? The valuations, unless, of course, it still seems like they're not being valued properly by the market. A lot of times, you might have some comparisons that still haven't added up yet. Okay.
Makes sense.
And you just always want to do your comp valuation and really make sure that you know where the stock stands in relation to that comp valuation.
So with regards to those like competitors, as you call it, and do you have any favorite SPACs right now?
No, most of the ones that I've looked at recently, other than a few that I've written up, the ACTC/Proterra, I like that one. It's really, really hard for me to find something in the SPAC universe that I'm really super excited about.
So what makes you excited about a SPAC, for example? What are you looking for in a SPAC like Proterra?
Well, I'm looking for a comp valuation that is, that I can easily value. Remember, everything in this market is about how you can easily value something. If you have to go through some kind of convoluted way to figure this out, then no one else is going to figure it out. So it's got to be, hey, your competitors are trading for 20 times revenue or 20 times EBITDA, and you're trading for 10 times. So there's some kind of disconnect there. But then you got to ask yourself, why is there a disconnect? So you got to look for those kind of things. Right now, I'm being a little bit more cautious in the SPAC arena because I'm not finding that as much.
SPAC arena, I like that one. Sounds pretty good. So with regards to the easy valuations, one thing I have trouble with is to determine the correct amount of outstanding shares after the merger. Because when I look at, for example, at Switchback Energy, right? They actually have their call today, I believe, to vote on the merger. In the investor presentation, I believe they state they are going to have 304.9 million shares. And then when I look at their S4 filing, I see 4 different scenarios with 4 different kinds of outstanding shares after the merger. And none of them are at 304.9 million. How can we actually figure out the correct amount
Well, remember,
of shares?
in evaluation, you always add up all the classes of shares. The total number of shares, no matter how many voting rights they have for each class, are still common stock, okay?
Right.
Unless they're not common stock. So if they are common stock, doesn't matter what class they are, you just add up those common stocks. Where it gets complicated is if they have warrants, and the warrants are in the money, and you know they're in the money, but they haven't yet been exercised.
Right. Could you quickly explain a little bit what warrants are for people who might not be very familiar with those?
Warrants are options.
Right.
Same thing as you see in the option market, except that the person who gets the money is not the person in the option market who sells it. The person who gets the money is the company. So when you have the right to buy a stock, the company issues a warrant or an option, if you will, to a long-dated option to buy the stock from the company itself. So it will issue more shares of its own shares outstanding to the private individual who has the warrant during the exercise period, and he has to put up that cash unless, and this is also where it gets complicated, almost all of these warrant deals have cashless exercise options in them. However, I've been noticing that despite the cashless exercise options, a lot of the companies have been requiring people to actually come up with the cash, right? Despite the cashless exercise price option that is usually at the option, if you will, of the company to allow the cashless exercise or not.
All right. It starts to become a little bit complicated.
It gets a little bit mathy, yeah, but essentially what happens in a cashless exercise is the company says, all right, if you had given me that cash in a real cash transaction, I would have gone out and bought those shares to cover, the amount of shares I got to issue, and here's the price today. Therefore, the difference then is the number of shares that would be left outstanding because the option would have had, the warrant would have had a lower price. So there would have been a small or a difference in the number of shares after the company had bought the shares in the market to cover. As a result, that remaining amount of shares is what's called the cashless exercise.
Okay. So with all these warrants, is there like any way we can determine the exact number of outstanding shares?
Yeah, you got to keep a spreadsheet.
Okay, but is there like a filing from the SEC that we can check?
No. And this is what irritates me a lot of times too with companies. A lot of times I'll go in, I'll meet with management, and I'll say, okay, here's my spreadsheet. Tell me what I'm doing wrong here. You claim there's a company that I'm following. I have a huge stake in. I'm sorry, for my net worth. It's based here in Scottsdale. That I go in and meet with the management, and I say, well, yeah, I know you got 10 million shares, but you've really got 15 million shares. Right. Because everyone's got all these options. Now all the options are in the money.
Exactly.
Tell me and then you have to decide whether or not they're cashless exercise, because if they're cashless exercise, then there's less shares that will be issued, et cetera. So it gets very tricky. So it depends on the stock price. Obviously, if everybody's in the money, then you can essentially, I always act as if the shares will be issued at some point. Now, under and this is where your CFA thing comes in, under the rules in GAAP for determining earnings per share, there's called the dilutive method, which means that you have to actually act as if the shares were issued and you bought back the stock with the amount of cash.
Right.
And that's how you actually calculate the earnings per share with the amount of in the money options or warrants.
Okay. And is that a number we can like find somewhere?
No, you have to figure it out yourself. That's what
Okay.
analysts do, and that's what the CFO does. Some companies will actually show you their calculations in their footnotes,
Yeah.
and some of them won't.
That's a little, especially for retail investors, that's quite difficult, if you know what I mean. It's quite difficult to, yeah,
Really
exactly
won't
know
matter,
what a
I don't
market
think.
cap is.
Most options or warrants are not greater than, I would think, 5 to 10% of a company's share balance outstanding. If they're greater than that, then you got a big problem.
Okay.
Um,
Because
and
for your SPAC valuations, do you look at the investor presentation with regards to the
yeah,
amount
I
of
just use
outstanding
the number
shares?
that they give us
Yeah.
because there's usually a little footnote there saying whether or not they include the warrants or not include the warrants.
Okay.
Typically, the warrants are not included
All right. That's good to know.
because they are using a $10 stock price in their initial EV calculation.
And the
Okay.
warrants are 11.50.
Yeah,
Right.
exactly. And so if you think that because the stock's now at 20 and blah, 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 and you can just add up the number of warrants by scanning through, what I do is I use the control find in the SEC document just for the word warrants. And so I can go through everywhere all the warrants are, add them up, put them in a spreadsheet, and just assume that they're all in the money. And then you can say, okay, within 60 days or whatever. Oh, and that brings up another thing. A lot of these warrants, the company has the right to redeem them. Okay, within within a 30-day period once they announce it, and they have the right to redeem the warrants by doing the following: they can buy them back typically at 1 cent per warrant.
Right. Okay.
So they force the whoever owns the warrants to convert them or exercise them.
Right.
Which is another reason, and I've been noticing NIKOLA did that, all these other companies have been doing that. As soon as the stock is public, you typically within the first month or two, you'll see the warrants getting redeemed and forced converted, which also becomes very tricky because now before even the first quarterly earnings come out, you've got a whole larger number of shares outstanding.
Exactly. And that
But
dilutes the shareholders as well.
right. So now you have to redo the valuation, but you also have cash in the bank from the exercise price. And that's why a lot of these companies are doing it, because they see it as a secondary offering that allows them to get more cash.
What I also see a lot is that when SPACs vote on the merger, they also vote on a proposal to increase the amount of authorized shares they have. Do you think that
Yeah.
after the merger is completed, they're also going to issue these authorized shares?
Well, in many cases, there's not enough authorized shares to complete the merger.
Okay.
Let's
Right.
say that because you got to give shares to the private company, you got to give shares to the PIPE, you got to give shares to the sponsor. You might have a bunch of warrants. You might have a bunch of debt that is going to get paid off at the close that will have warrants, and the banks with these warrants, they want their money right away. So
Right.
blah, blah, blah. So if you add up all of that, oftentimes there has not been enough authorized shares in the SPAC IPO.
That makes sense,
However,
but
if they're smart, they will have done that. But
yeah. Now, the thing is, with again Switchback Energy, for example, I believe, well, as I said, they're probably going to have more or less 304.9 million shares. But I believe they're going to vote on a proposal to increase the amount of authorized shares to 1 billion shares.
Okay.
So I'm actually wondering if they are going to issue the additional 700 million shares at some point to dilute the shareholders and raise more money. What do you think?
It's interesting. 3 times. How much cash did they raise?
I'm not sure. Not sure.
Yeah, that seems a little excessive.
I'm not sure if they're going to approve the proposal, of course, but that is in the S4 filing, for example.
Interesting.
Yeah.
Well, I would look at to see how close it is. That they must have a lot of warrants. They must have a lot of RSUs and those kind of things outstanding that might need for this to happen. But a lot of companies will do that. They don't want to keep having going back to the shareholders to issue authorization to issue more shares, because they feel like if they have to do that in the future, then it really will raise a lot of red flags.
Right.
So they'd rather get it over with right now.
Okay, makes sense. That's actually some people are actually wondering if SPACs are in a bubble. I've already talked about this a little bit. Do you think we could see in the future some like potential signs of an actual SPAC bubble? What kind of signal should we be looking at if there is actually a SPAC bubble?
Yeah. Remember, bubbles always get burst when there's a major either industry change or a major sort of environmental change. The most important environmental change in the SPAC industry, I think, would be if interest rates start rising, because at that point, people will start looking at alternative uses for their cash other than speculative investments.
Right.
Let's say interest rates rise to 3 or 4%, right, within the space of a year, because inflation starts ticking up. Well, that'll prick the bubble. Unless you had a whole bunch of SPACs that were just super overvalued, you know, and I don't see them being super overvalued. They're still sort of tethered, although that tether is getting longer and longer, to the underlying revenue or EBITDA of the companies. But think about it this way. Essentially with SPACs, you are getting the ability for the public to get in on the value creation cycle of a company earlier than they would in the IPO process. And as a result, there are valuation aspects there that you're getting you're sort of becoming your own private equity fund, if you will, by buying into these SPACs. But I do think that there should be some more scrutiny by the market, not by regulators, because regulators would just mess it up, on how pipes and the sponsors themselves are getting remunerated in this whole process.
How could people like me do that?
Let me give you a real good example. This Lucid deal with CCIV.
Yes.
If they pull this deal off, and by the way, it's based here in Phoenix,
okay.
Just down the street.
You mean CCIV or Lucid?
Yeah, Lucid is in Casa Grande, which is 50 miles south of Phoenix. It's halfway.
You go check?
It's halfway between Phoenix and Tucson.
Can't you go check if they're actually going to work with CCIV?
Yeah, by the way, NIKOLA is building a plant in Casa Grande too.
Should go to Trevor Milton.
Here's the thing. If that deal, and where's the stock at right now? $24 or something like that?
I think even higher. I've seen it at like 34 or something like that.
There is no way they can allow a pipe to come in at $10 if that deal gets closed. That would be, to me, just beyond ridiculous. Okay? Do you see what I'm saying? How could they in all good faith say, okay, we've got 500 million in the SPAC, but oh, by the way, you can come in here at $10 and you get to make more than 100% on your money just for saying you're going to put up the money, you know? If I had $500 million, I would call them up that day and say, stop, I'll give you the deal at $15.
Right.
In fact, at some point that will happen.
But you're saying it should not be regulated, I believe, right? I think you've just said something about regulators that they should not be the ones
work this out. You know what I mean? You got to let the market come up and say, okay, you might have more of an auction process happen for the SPAC or the pipe deal to happen, or force the pipe to, I don't know. There's got to be some more conditions put in it, I would think. But if whoever's running Lucid allows a pipe to get in there at $10, to me, that would be the ultimate sort of. These guys don't really care too much about shareholders. That's what I would say.
Okay. Okay, so we have interest rates. If they are going up, that could mean bubble bursting. We need to look more into these pipe things. Are there more signals retail investors can look at?
Well, I just don't like paying 10 to 15 to 20 times revenue. Those are numbers you're supposed to be paying for earnings,
Right.
I'm halfway willing to do that for a SPAC where the industry itself is selling at 20 or 30 times revenue, maybe, and or if the company is very quickly going to be producing EBITDA or even adjusted EBITDA within the next year.
Yeah. Just a quick side note, by the way. So you say EBITDA instead of EBITDA, right?
Yeah.
Yeah, okay. I usually say EBITDA as well, but some people get really mad when I say EBITDA instead of EBITDA.
Really?
Yeah, I'm not sure why, but
EBITDA earnings, earnings. I don't know. I say the word earnings, so I use the
yeah,
swap.
yeah, yeah. Me too. Me too. I'm very used to saying that as well. And I actually ran a
Yeah,
poll on
I've heard
my
that. I've heard
actually
that
ran a
before.
poll on my YouTube video, and like 40% said EBITDA, and like 30% said EBITDA. So
Oh, really?
I'm still using EBITDA, but yeah, some people get really angry when I say EBITDA.
So signs of speculation are that, and then of course if you get quacks in there, like this Trevor Milton guy,
Yeah.
or if you get fraud. I haven't seen any fraud happen yet.
Hopefully not. Well, I'm
Yeah.
not sure. Well, you could maybe. Well, I'm not going to say it happened, but some people could say that the NIKOLA issue was actually a fraud because of the truck that was. What was it again? Like the truck in motion or something like that. I'm not sure if you remember that story.
Well, the company still has 900. I mean, I just wrote an article on NIKOLA the other day. I don't think it's been published, but it's coming out. But theoretically, it's really only got about $2 of real value.
Two
Now,
dollars.
yeah, based on
Okay.
that's 900 million in the bank. I mean, my article's thesis is where is the business plan? I'd like to see the business plan. They lost GM. They're not doing the Badger. They lost Republic Services. Remember, they were going to get like 5,000 dump trucks, right? Which,
Right.
by the way, Republic Services is based here in Phoenix. It's the largest,
Everything is based in Phoenix. What happens in Phoenix?
fifth largest city in the country.
I should go there.
And, I wear shorts here every day. Um,
Here
so
it's
anyway,
freezing.
is they lost all these deals. Where's their business plan? I'd like to
Yeah.
know, I have nothing to hang my hat on other than the 900 million which they're spending to build a plant and how many hydrogen
Well,
trucks they're coming out with. Where's that plan? I'd like to know. They haven't put out any press releases showing us what they're doing. So it's they lost management and they've got these two other guys in there. So I don't know. Maybe they do. Maybe they'll come up with something. I'm sure
I'm
they'll
looking
get
forward to reading your article where it says $2 per share. That's going to be a fun one, I think.
before that explaining the $2, 250 per share.
250.
But the value of the business itself might be worth maybe $5 or $10 at most if there was a business plan. But where's the
Right.
business? I'd like to see it.
Yeah, makes sense. I think we've already talked quite a bit about SPACs, but I believe you are also a poker player. Is that correct?
Yes, yeah.
Do you play cash games or tournaments or?
I like tournaments. We have a lot of casinos here in Phoenix. We have like 8 casinos, and I'm only 4 hours away from Las Vegas, so I drive there, and we're only 4 hours away from San Diego.
Right. Yes, I'm asking because I'm a fellow poker player as well, and I'm wondering if you see any similarities between poker and investing.
Were you a poker player? What do you play, cash or what?
Mainly tournaments as well, online. Yeah.
Oh, online, yeah. What kind of blinds do you play in cash?
I don't really play any cash games. I've almost never played. I think I've never played cash games in a real casino, only online as well.
Okay.
And when I played cash games, that was like 10 years ago or something like that online. So mostly I played tournaments in the last couple of years. And I did a few live tournaments as well in the casinos here in the Netherlands.
What kind of buy-ins do you do?
I think the tournaments were usually like, I think between 200 and, well, the highest I've done was 700 euros.
Nice. Did
Yeah,
you
that
rank?
was like the main tournament. I didn't win the 700. No, I think my best position, position in a tournament was like fifth for like 3,500 euros or something like that. Well, it was pretty cool. And
Very nice.
online, I also won a tournament for like a little bit more, but yeah.
Are you a tight or a loose player?
I think I'm a little bit more loose aggressive. Well, semi loose aggressive, I would say.
Well, you asked about probabilities and things like that, how it relates to investing. My attitude about poker is that you can count your outs, right? When you're in a hand. And in fact, there's a lot of sites out there now that show you how you can calculate your supposed outs divided by, the number of potential cards. I
Yeah.
find that a very elusive number though, because theoretically you could say, okay, I've got two of the aces, where are the other two? Well, it's very unlikely that and there's a third one out on the deck on the flop, let's say. So you could say it's very unlikely somebody else has got an ace. Therefore, you've got the trip aces, but there's a king and a queen there. So somebody could easily have 10 jacks. So you could actually be behind. So you have to sort of
Right.
count your outs versus, and you also look at the flush, whether you have flush outs too.
So what does that have to do with investing?
The amount that the person is betting against you, and you have to take that money and divide it by the pot, plus you have to add in your money that you're going to have to add in, and you're going to compare those odds with your odds and determining how many outs that you have divided by the total remaining cards that are out there.
Right.
Therefore, you can see which one it has a higher probability, and therefore, if you have enough, if you have a suited connector and you have both, open-ended straight and an open-ended straight flush and a flush possibility, you've got something like 33 or 32% odds, right?
Right.
And if the pot is if the guy only bets 100 into a $500 pot, you only have to put up 100. So you have a very, very good odds. There's 20% odds there. So your 30% is greater than the 20% in the pot. Therefore, it's always to your advantage to hit and call at that point.
So this beautiful story, what does it have to do exactly with investing?
Yeah, you take your odds and you compare it to the odds available in the market.
Okay. Explain that.
You look at in the stock, you look at the probabilities that it's going to double versus probabilities that you're going to lose your shirt. Okay, and you put
like a risk-reward ratio.
Yes, it's not as complicated in that case. By the way, I wrote several articles about AMC and this group Naked Brand right before they shot up, putting together the odds.
Right.
And I wrote that on AMC when it was at like $3. I said, look, here's the odds. There's like a 50% chance it's going to triple, right? So that would give you 150% potential expected return, 0.5
right.
to 300. But there's a 50% chance that it's going to go out of business. So 50% times 100, negative 100 is negative 50. So negative 50 plus 150 is 100, or
right.
doubling money. So I said there's a very good chance you will double your money. Therefore, you should be buying at $3. That's what I wrote.
Okay. So apart from calculating odds in poker and in investing, do you think the mindset of a poker player could also be used for investing as well?
The patience aspect
right.
of poker is very important, because you're constantly getting hands that are just rubbish. Queen 8 is nice. Queen 8 clubs suited is even better.
7 deuce offsuit is NIKOLA.
It's not as good as a queen, Yeah. So how patient are you going to be,
Right.
And that's the same thing in investing. You take your profits when you have them. That's another thing I learned from blackjack and count carding in blackjack. You take
count carding.
Okay, so if you've made 150%, the stock is up dramatically. What's left? Where are the catalysts that are going to make this move even higher? You know what? Take your profits, especially if you did on margin, like I tend to do.
Right.
Same thing in blackjack. If I've been there 45 minutes and I've doubled my money, I'm out.
I like the patience. I like the patience aspect, because I think, especially many young investors they try to invest for the long term, but they don't have the patience to wait for the long term. They want to become a millionaire tomorrow instead of over in like 50 years or something like that. So I do think that could be an issue, and I think that poker players could actually benefit exactly from that.
Yes, playing poker and that mindset in poker, basically you throw away about 90% of your hands. All right.
Yeah.
At least I do.
Oh, I don't, but yeah.
I do.
A little bit more loose aggressive, as I've said. I'm a bit more like 30% or something.
Yeah, I play especially as you get further into the game, right?
Yeah, true. Yeah, definitely. Yeah, it depends on how many players as well. So, interesting question. What do you think are like the pocket aces of stocks? What is the best stock out there?
Right now, I like Mara, M-A-R-A, because it's a sum of the parts play, even though it's still up, even since I've recommended it in both. My son just got into it too, and he made a bunch of money. It's a Bitcoin play. Basically, they're the largest Bitcoin miner in the world. They're constantly buying ASIC mining equipment, which are application-specific integrated circuit mining. So it's based in Canada, I believe, and they're making about 60 to 65 Bitcoins a day, I think.
Okay, could be.
And they just recently announced, before anybody else said they were going to do this other than MicroStrategy, they just announced that they're putting like 150 of their 450 million in cash into Bitcoin itself. So here we are, the largest Bitcoin mining companies. You can add together the value of their Bitcoin, add the value of their cash, and the value of their Bitcoin mining business. And as Bitcoin itself goes up, so it's an easier way for me to play Bitcoin than actually buying it.
So you don't own Bitcoin yourself, but just Mara.
No, I think Bitcoin is not the one I want to buy.
Okay.
I'm going to buy a different one, but I'm not going to tell you which one.
Ooh, is it DOGE?
If I'm looking for an easier play in the Bitcoin mining arena.
Okay, so a stock or a crypto?
I want to buy a crypto, and I want to buy an easier Bitcoin mining company.
Okay, interesting.
But I'm looking for more of them, like Mara.
Are you going to write an article about that?
Marathon Path.
Right. Are you going to write an article about that crypto you're going to buy?
After I buy it, I'll write
it. Okay. Don't pump and dump.
Oh, what I'm doing. I've already pretty much given enough clues.
All right. That's going to be exciting.
I write on Medium, and I write on Investor Place, and I write on Seeking Alpha in terms of, I have a marketplace service there called Total Yield Value Guide.
Yeah, I'm definitely going to put the links to your websites, to your Medium, to your Investor Place articles in the description, so people can actually follow you and see what kind of awesome things you're going to do and what kind of crypto you're going to buy, actually. So I think we can almost already conclude this interview. Do you have any concluding thoughts or any tips, any suggestions for retail investors?
Today, be very careful with options. I don't think that's appropriate for most people because, remember, 90% of options expire worthless, all right? The only options that I play are covered calls and covered out of the money calls, and I sell out of the money puts.
Okay.
Try to capture, if you're going to buy something, see if there's see if it issues options, or see if there's options available. And instead of paying $10, $20 for it, maybe you can buy the $17 or sell the put for this $17 out of the money put, and you just keep on constantly selling those every week. And you might pick up that $3 so that if it's still trading at $20, you can then later go in and buy it at 20, but now your real cost is only 17.
I need to learn more about options. I still don't know enough about options. I can't even buy options on my own platform in the Netherlands over here. So, really just need to look into that. But I think
use like Robinhood or Webull?
No, we don't have Robinhood or Webull or M1 Finance over here. We've got different platforms, and most of them don't have all the options, no pun intended, that are also available in the United States.
You telling me nobody in Holland can buy
There are possibilities, but at least on my platform for, well, many of the stocks that are very popular right now, I can't buy options. I think for now on my platform, I am only able to buy options for ETFs, for example, instead of singular individual stocks.
Interesting.
But I think, well, I just need to look more into other platforms, but I suppose there are more platforms that actually do offer options.
Robinhood is not in Europe.
Sorry?
Robinhood is not in Europe.
Not yet. No. At least as far as I know, they're not here yet. They definitely need to come here. If they don't mess up.
Interesting.
Yeah.
Huh. Well,
Okay.
stay away from options unless you really know what you're doing. That's what
Steer
I
away from options. Okay. Awesome. Okay, again, I'm going to link all the I'm going to put all the links in the description so people can actually follow you on Investor Place and Medium. I would like to thank you a lot for your time. I would also like to thank you, and I should have done this at the beginning, just for the articles that you've written, because these articles were actually the basis of my own valuation videos for SPAC. So I really thank you for the effort you've put into that.
I'm glad you were able to get something out of it.
Definitely. Okay, again, thank you for your time, and then I hope to see you in the next one.
All right, thank you.
Okay, bye-bye. All right, I hope you enjoyed that, because I definitely did. Now, if you did find some value in this video, please consider sharing the video with your friends who are also investing in SPACs. And again, remember, if you're an expert in a stock, a company, a cryptocurrency, whatever, send me an email at support@nesami.com and we can see if we can have a chat about it. Thank you very much for taking the time to watch this video, and I hope to see you in the next one. Bye-bye.